Well, the US Treasury Secretary Janet Yellen is trying to project calm to Americans as a banking crisis looms. Well, the collapse of two major banks could impact the Federal Reserve's plans as to whether it increases interest rates or not.
The situation is stabilizing, and the U.S. banking system remains sound.
Treasury Secretary Janet Yellen trying to restore confidence in the banking industry after the sudden collapse of Silicon Valley Bank in early March, followed by New York-based Signature Bank. The government protected all deposits at both banks, even those with amounts above the federally insured $250,000 limit.
You should rest assured that we will remain vigilant.
At the annual American Bankers Association summit in D.C., Yellen said swift government action protected the industry and the economy, and that more might be necessary.
Similar actions could be warranted if smaller institutions suffered deposit runs that pose the risk of contagion.
She says she wants to avoid large-scale withdrawals across the country on fears of more collapses. The U.S. is reportedly studying ways to temporarily guarantee all bank deposits. A banking meltdown could derail the Fed's plans this week to raise interest rates again. Fed officials are expected to announce a quarter-point rate hike. Some investors have called on the Fed to hold off, citing worries over more stress on American banks.
I do think the Fed is responsible for some of this bank fiasco.
Some economists argue the Fed should stay the course.
I think in the long run, they need to say, let's stay with the priority being get inflation back down so that we can now manage this economy.
The Fed's two-day meeting begins Tuesday with an interest rate announcement expected Wednesday.